Okay, so welcome all. Welcome to Financial Freedom. My name is Samir Bapat, and today we are going to learn about how to earn money using moving averages. We are going to learn two types of moving averages. One is simple moving averages, mostly used for long term trading. Like there are many people who buy the share for long term. Mostly simple moving averages are being used by them, not to trade, typically to know what is the trend of the market. Second is exponential moving average. Today we are going to learn how to use exponential moving average to do a short term trading. So I'll be sharing with you both, how you can trade long term, how you can trade short term. Everyone ready? Can I have yes from all of you if you are ready to learn and earn lots of money? Yes. Okay. How about others? Only. Okay, great. Others are typing. Takes time. Okay. Thank you. Thanks for your confirmation, so that I know I am addressing the right people here. Okay, so what is an indicator? Now we have gone through the journey so far in last two webinars. In last 3 to 4 webinars, we have learned what is technical analysis. Technical analysis is analysis of price action. Then we went through candlesticks. What is candlesticks? How is the basic candlesticks works? Now we are going and learning about moving average. So moving average is an indicator. It's a very old indicator, a very basic yet but very powerful indicator. So let's understand what is an indicator. Indicator is a thing which indicates. Okay, so now why I'm stressing on the word indicates is people think that indicator is everything. No, indicator is not everything. It only indicates what is the possibility of occurrence. It only tells the possibility of occurrence. Indicators were designed, developed by all the developers. Like there are 300 plus indicators. No need to learn all. You cannot use all. You have to use only one or two. Indicators were designed to take a trading decision. When we are trading, do you agree? We have only two questions predominantly, and third question everyone should have. The two questions are: when to buy a share. Once you have bought, the next question is: when should I exit from the share? When should I book the profit? Or is it going to go down? Should I exit? So that is the second question. There are only two questions which everyone asks. Third question is, which everyone should ask, is how many shares should I buy? This question is typically not answered by the indicator. It is only answered by the risk management techniques. So there are three questions which you should always have in your mind when you are trading in a share, or when you are going and earning in a share. When I should buy a share, so you should have a system when to buy. Second is how much to buy. Third is when to exit. And fourth is for sure how much money to invest into that share. So these are few questions, and indicator helps us in answering those questions. So I'm again stressing on the point: indicator only indicates. I have not seen any indicator which will guarantee कि नहीं ये करो and you will earn money. No, indicator will indicate. You have to practice and master that indicator to earn consistently. Everyone okay with this thought that indicator will only indicate? It's not a guarantee. It's a, you can say, warranty, or you can say it's a high probability of getting the winning trade. Can I have yes from all of you if you are agreeing with me, if you are okay understanding this? Yes. Always remember, I have 14, I think now it's almost 18, 19 years of experience in stock market. I have not found an indicator which will give you a guaranteed signal कि नहीं ये low and you will have. There will always be drawdowns in all the indicators. Why it was developed? Why moving average was developed? Again, the same requirement, like I said, when to buy, when to sell, simple. Earlier days, till 1970s, people were more fundamental. Uh, People were more fundamental. They were analyzing the companies on a very detailed level, and then they used to trade. Then someone thought, nahi, nahi, about people like you and me. They thought how to help these people, so they developed the moving averages. So it was said, okay, if the price is above the moving average, it is good to buy. If price is below the moving average, it is weak, you have to be cautious. So this is the history of moving averages, how it is calculated. I'll show you in some time. Most commonly used moving averages are 200, 50, 20, 10, and 5. So these are the moving averages which are mostly used, commonly used moving averages all over the world. Now you'll say whether it is in India, US, UK, Japan, Canada, Australia, any country you go, wherever human beings are trading, most commonly used moving averages are these only: 200-day moving average, 50-day moving average, 20-day, 10-day, and 5-day. Now, the question might come to you is, okay, before we go to the moving averages, I'll answer that question. So, disclaimer, I told the disclaimer indicators only indicate, there is no guarantee, there is no indicator which will give you guarantee. No, if this happens, you buy and you will have profit. No, there is always a chance of failure with all indicators also. Now, before we go into nitty gritty of moving averages, this is the final slide from my side. Moving average will work only on fundamentally good stocks. Don't apply moving average on any stock. First and foremost requirement is you go and find decent, fundamentally good stock. We have gone through in our Sunday session 3 weeks ago. We have gone through the how to find fundamentally good stocks. You can select few stocks out of them, and then you can apply moving average. When to buy when the price crosses above the moving average, when to exit when the price closes below the moving average. As simple as that. Okay, so ready to jump into the action. Okay, so let's jump into the action straight away. Now, okay, simple. How many of you have learned how to? Why it's not coming? Okay, sorry. Okay, what is this coming? Introducing. Okay, don't care. How many of you have studied in their maybe ninth or eighth or ninth class how to calculate averages? Can I have yes from everyone if you have passed at least 10th standard and at least you have studied? Okay. 10th standard pass, yes, say yes or say 10. I have everyone who has cleared 10th standard should say type 10. Even if 8th standard, if you have cleared, good enough to earn money in stock market. Oh, great. I have a lot many people passed who have passed 10th. Okay, great. Fantastic. So you are all eligible to earn money in stock market. Just to refresh your memory, maybe you have forgotten. बहुत साल हो गए. It was long ago. I have done the moving averages, so I don't remember how to calculate the averages. I'll just take you through. So what you have to do is simple. If the values are given 6, 8, 6, 7, 2, 9, 10, 15, and these are how many values? 1, 2, 3, 4, 5, 6. If the values are 6, how to calculate move averages? How to calculate averages? Sum all the above and divide by 6. And what happened? क्या गड़बड़ हो गई, is equal to sum. Okay, this is the sum divided by 6 and 1 2 3 4 5 6, and this is how we get the average. Correct? Have I done it correctly? बराबर है ना? So simple way of calculating the average is, simple average is we add all the numbers divided by total number of numbers. Same way, when we are doing moving average, what is done is closing prices are taken. Like what we have discussed is closing price. Every day 3:30 the market closes, every share will have its closing prices. So the average is calculated by adding this closing prices divided by that much number. For example, if I have to put moving average, this will be a simple moving average, let's say for 5 days. 5. Let me make it darker. Okay. Now, if you see how this line is drawn here, this point is calculated simply by adding 1, 2, 3, 4, 5, 5 closing days value divided by 5, you will get the value of this point here. Same way for this point here, it is calculated 1, 2, 3, 4, 5, 5 days average. It is plotted here for this date. It is calculated for 5 days. So 5-day moving average, it is calculated adding 5 days closing price divided by 5. Whatever value comes, that value is plotted on this graph in form of this line. So this line is nothing but whichever date. Let's say if you want to see what is the average here, how this point has come, then 1 2 3 4 5, 5 previous day closing divided by 5, the value will come, and trading we will plot the chart accordingly. Everyone clear? Any questions how it is plotted, how it is calculated, and how it is plotted? Everyone good? Can I have CC? Can you please type CC if everyone is clear how this 5-day moving average is calculated? Okay. So it is, whether it is 5-day, 50-day, 200-day, it is same. So now if you see, change it to inputs. If you say, someone says, okay, I use 50-day moving average. So we have changed 50. I'll take you through it. See now 50. So what happens is, suddenly you see the line has changed, because now the 50-day, from here 50 days are calculated: 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15 16 till 50. All the closing prices are added up, divided by 50. Whatever value comes, this line is plotted as per those value for each day. So 50-day moving average, 200-day moving average, 10-day, 5-day are calculated. Simple moving averages are simple calculation, and they are plotted like this. Exponential moving average, this is the formula. It's a very complex formula. You can go through it. Not complex. It's a investopedia.com. You can check out the exponential moving average formula. You can look at it. Exponential formula is nothing but it gives more weightage to the current price, so it's little bit faster. The movement is little bit faster. If I am putting exponential moving average over here, EMA, then now here if I say is 50, now 50 50, and style is, let's say, let me make it red and let me make it thicker, you'll see that 50-day moving average is moving little faster. It is more closer to the price action. So if the price is going up, moving average, simple moving average will take little bit time to react. Exponential moving average will react faster to the price. That is the difference between simple moving average and exponential moving average, because exponential moving average, the uh, weightage is given more to the nearest price. Everyone good? So far so good? Yes, no? Okay, great. Now let's remove the exponential. Let's speak about this simple moving averages. The first and foremost moving average. Okay, so if you want to practice, or should I go ahead? Is my speed enough? People will be practicing later. Is that okay? I'll go little bit with speed. You can understand, and then you can watch the video on YouTube and practice along with me, along with the video. So I would request you to practice definitely a lot many number of times as you are going and watching the video. Okay. So now let's say I'll start from the beginning. I'll just start with the, so what you have to go do is go to the indicators, type moving average. First start understanding moving average with moving average. So this will come as we have learned how to bring the indicator, go to inputs, change this length to 50, make it little darker so that it's clearly visible, make it darker. So let's start with 200. 200. Now this is the 200-day moving average. Now, like I said, there are the moving averages which are used are 200, 50, 20, 10, and 5. Let me ask you one thing. Why there is a moving average of 10? Let's start with the logic of 10. Then you will understand why there are moving averages 10, 20, 50, 100, 200 typically. Let me tell you, if you are taking a moving average of, okay, before that, imagine if you don't have a calculator, you don't have a laptop, nothing. If you have to do manually, you have to write the closing values every day. What will happen is the closing price will come in newspaper, and in from the newspaper you have to put it on your notebook. On the notebook, you have to calculate the moving average and then plot it on the graph paper which you have been doing in the childhood. Now if you are making an average every day manually, which will be easier, to take a 10-day moving average, add 10 days value and divide it by 10, or will it be easier to take a 7-day moving average or 17-day moving average? What will be easier, to manually prepare 10-day moving average, or to manually prepare a 17-day moving average or 22-day moving average? What will be easier? If you don't have any calculator, no laptop, no computer, no mobile, no calculator, only manual. No, it's not lesser the better. It's not lesser the better, Tia. What will be easier to divide by? Will it be 10 or 22? Will it be 10 or 17? What will be easier, right? You imagine the life of the traders when they were trading. There was a time in this world when there were calculators were not available to the investors. They used to calculate everything manually. For them to plot it and see where the market is, it was easier to do manually, and it was easier to calculate by dividing by 10. How many of you are with me? Yes. Now that's why what has happened is the moving averages that came in the system were multiples of 10, 10, 20, 50, 200. So you might say कि यार 200 का क्या logic है? So first logic is it was easy to use. If they had 200 days sum, they would divide by 200. It was easy to find out. If they had 50 days of average, it was easy to divide by 50. It was easy to find out. So the averages which came in the practice were 200, 50, 20, 10, and 5. That is one part of his. That is ease of calculation. That's why all these averages are being used for last 50, 60, 70 years. So they are still valid. You can still use them. Majority of people are using this 200 and all this moving averages. That is point number one. Point number two is 200 days. If we say 365 days a year, we have 52 weeks. 52 weeks means roughly 100 days of holiday. Saturday, Sunday, if you include, then there is a roughly 100 days the markets are closed. 104 days the markets is closed. So, and plus there are some 10, 20 days of holiday. So 20 days gone. So 120 days the markets are closed. So overall, the market is open in a year for around 240 days. Everyone okay? Everyone getting the picture? How many days the trading will happen in the market is roughly 240 days. Yes, no? How many people are getting this? The total number of days the trading will happen in a year will around 240 days. Abhi, the calculation ease is there. So instead of dividing the all closure values by 242 or number of holidays, they said, nahi, the people found it simple. They said, okay, we'll divide it by 200 and make it a 200-day moving average. That is the first long-term average which has come, which we have brought in here. It is moving average, 200 days simple moving average. Exponential and all came very later. First is moving average, 200-day moving average. How it was used is simple. Buy when the price closes above the 200-day moving average. Okay, so let's say someone analyzed BDL sometime back, and so they would buy for a long term. If someone is identifying BDL for long term, they will buy as soon as the price closes above 200-day moving average. They will buy here. And when will they sell? They will sell when it closes below the 200-day moving average. So after the purchase, the price is still above the 200-day moving average. So it's still there. They might be still holding, and they are holding. So long-term players, first they will identify a good stock and they will buy once it is above 200-day moving average and hold on as long as it is in uptrend on the yearly basis. If it's an uptrend, if it's above 200-day moving average, it is indicated that it is in a long-term uptrend and they will keep on holding as long as they are. Good? So far so good? Yes, no? Now the challenge is, let's say if I identify BDL today, okay, if I want to buy BDL today, now it's very difficult, right? If it's very difficult, should I enter now? It's already so far away from the 200-day moving average. Is it okay to buy right now or not okay to buy right now? So that is one challenge which came with the 200-day moving average. So people thought, okay, next is let's bring in the 50-day moving average. Why 50-day moving average? So I'll just change the settings. I'll bring in the next moving average, which is moving average, which is 50-day moving average. So let's change the settings to 50. And let's make it what color? Green color, let's say. And let's make it thick. Okay, so now people had a shorter duration. I'll just hide 200 days so that there is no confusion. People had a shorter duration to manage. Why 50? Because in a quarter, there are 90 days. If you see, there are weekends, if you remove some holidays, if you remove, there are around 65, 63 days, working days in a quarter. We have a quarterly result, right? Every company declares its result every quarter. Every 3 months they declare quarters. People wanted to know how it is doing quarter over quarter. So 50-day moving average, because of the ease of calculation. Now you would say, why not 60? Because dividing by 60 and dividing by 50, 50 is easier. So they were using without calculator, so they used 50-day moving average, which is a decent enough. Now we have a 50-day moving average. They have simple system. When it goes above, you buy. When it closes below, you exit. Now because of this, there may be no earning, right? Then again it goes up, you buy here, you hold on, you will keep on holding. So rather than 200-day moving average, now if you see, you have more entries here, right? If it is above 50-day moving average, above 200-day moving average, if it crosses above 50-day moving average, you can buy and hold it, the trade. So how to trade 50-day moving average? The principle is same. Buy when it goes above the 50-day moving average, sell when it closes below the 50-day moving average. Trading the 50-day moving average is same at across all the levels. So what happens is you capture the quite big uptrends. The problem is if there is a whipsaw, if it goes up and down, you will lose a lot of money. But remember, the 50-day, this moving averages, it is only for creating the foundation about the indicators, how to understand the indicators and how to use the indicator. Moving average is the first indicator which you are learning. So this is how the moving averages are used, 50-day and 200 days. So mostly if you are a long-term player, use 200-day moving average. If you are a medium term player, then use 50-day moving average. The trading plan is simple. Buy when it crosses above. Every time it touches 50-day moving average, you can add a value. Okay, let me change it to candles. See, buy when it closes above the 50-day moving average, sell when it is closing below. So you can buy here, you can sell here. One method, simple method is there. Now you will say, okay, how to avoid this whipsaw? How to avoid selling here when we saw it going up? Okay. Now, second thing, what you can do is don't sell immediately when it closes below the 50-day moving average. Let's say you bought here. Okay, it went up, came down, and this candle formed below 50-day moving average. You put a stop below this below this candle, at the low of this candle, and if it goes below this, you exit. For sure you have to exit. Even if it is a loss, you have to exit, otherwise hold. If it goes up, you can exit. So by that way, what you can do is, see here, you buy here, it goes up, it came down. Okay, anyway you will have this, you cannot help. So whipsaws, it is difficult to avoid in 50-day moving average. It's only that if you can, you have to trade more on 200-day moving average and a short term on a 50-day moving average. Let's see how it performed. Okay, not here. Triveni, let's say Triveni. See here, you will find that it came and it kept on bouncing on the 50-day moving average. So what the principle I was telling you will work more fantastically here, where you buy when it crosses above this, and whenever it closes below, you hold on till the lower point. So it again goes up, again creates a lower point, again goes up, clear lower point, and you hold on to these points, and you are able to ride the wave from here to here. Fine, everyone okay? So far so good? Yes, no, hello. Okay. Now, the third option is short term money, because now we have people who want to earn quick. Okay, show me the money fast. So, for those people, Divakar, you can type your question some 10, 20 times more if you are thinking I'm not reading, but I have a way of sharing. So I'll go through my sequence. Okay. So even if you type 50 times also your question, I'll go through sequence and I'll come to questions later. Fine. So don't type again and again, again and again. I'm able to watch the questions. Okay. Great. Thank you. So let's go ahead to exponential moving average. What you have to do is you have to go to indicators and look at EMA, moving average exponential. Click it, click 2 times. So you will have a moving average exponential. Go to settings, input, change it to 5. Style, let's make it green, and we have the green line. Then you go settings, style, let's make it black, inputs is 10. So this is a exponential moving average 5 over 10. How do you trade this? You trade when the 5-day moving average crosses above the 10-day moving average here. This green one is 5-day moving average and black one is 10-day moving average. Now here, see on this day here, if you see the 390, 53, 390, 20, and here on this day, the 5-day moving exponential average went above the 10-day moving average. If I keep my mouse here, just see the values here for 5-day and 10-day. See, 5-day moving average value is 390.62 and 10-day is 390.55. As soon as the 5-day moving average, exponential moving average crosses above the 10-day moving average, you buy. And till what date you have to hold on? You have to hold it, the stock, till it crosses down. So on this day, the 5-day crossed below the 10-day, you exit here. So it's a crossover technique. 5-day crossing above the 10 and reverting, 5 crossing below the 10, you sell again. See, it remained below 5, remained below 10, it remained here, it has gone, you buy here. Again, it has crossed above, you buy here, it went down, you sell here. Again, this day it crossed here, you buy here and be in the trade as long as 5-day moving average is above the 10-day moving average. It closed here, you exit here. Easy? How many of you think this technique is easy and better and faster? Give signal fatafat, fatafat, fatafat. How many of you like this signal? Okay, good, easy. Right? So what you have to do is you have to have a fundamentally good stock. You cannot use this technique on any stock. You need to have a fundamentally good stock. Then you have to apply 5-day exponential moving average, 10-day exponential moving average. Every time it crosses above the 10-day moving average, you buy, sell when it closes. When the 5-day moving average crosses below the 10-day moving average. Please remember, all techniques have a drawdowns. Okay, all technique will have drawdowns. No technique is perfect for earning money. Okay, so Rajat is asking me, can it be applied to index 5-minute time frame? Please don't use moving averages if you are trading for 5 minutes. See, one is you need more reaction time, less reaction time. This is not a good technique for 5-minute charts. Daily charts, it's a fantastic. It was developed for the daily charts. 5 minutes, you have other techniques. Okay, so these are a few things I wanted to share with you. Wanted to create this. Wanted to share this moving averages with you, and long term and a short term technique for earning money. So depending on what type of temperament you have, you can use it. You can as well add the 20 EMA on this and add to it. So as long as it is above 20 EMA, you can do this crossovers 20 EMA. Okay, so you can as well have a 20 EMA. Let's say what color we give, red color. Okay, let's say red color. So 20, 10 and 5. Now, here is the thing. If it is about 20, you can add on every time it touches the 10-day moving average. See, if as soon as you buy when it crosses above, if you want to add more, you can. If it is about 20-day, or if both the lines are about 20-day moving average, you can add on more. If it is bouncing from here, you can add on more. Again, it has came down here, it did not bounce up, don't add. Here is your exit. So see how it will look bouncing. It came down, it stayed, and then it went. So once it touches, you can buy above this line when it starts going up. So that is how you'll see that it is bouncing. So this will help you in adding more positions. If you have purchased when the 5-day moving average crossed above the 10, you are buying here. Okay, it has gone into profit, you want to add more. When it bounces from the 10, then you buy. Should I buy every time? No, only if it is above the 20-day moving average exponential, then only you add more when it goes up. So you wait, you buy when it crosses, add when it bounces. That's it. Okay, so I'll open up the for question answer. If you have any questions, type in your name. I'll come to you one by one. Okay, I'm stopping the okay, we can continue the recording. Let's have. So if you have any questions, just type in your name. I'll come to you. Okay, no questions. How to know bounce? Okay, good question. So Sandy, when it has, see, it has gone up, it has come down, it has touched the 50-day moving average, right? So if it is touching, draw a line here, horizontal line. Whenever it closes above here, see this candle is closing above the candles which is touching the 10-day moving average. If it is closing up, you can buy here. So once it goes and buys, that is one technique. Second is if it starts pointing up, you can buy. See 5 and 15, 10, both are pointing up here, you can buy. So either way you can do. See, it went and touched here, it touched here. If you draw a line, it did not cross, so you don't add more shares in this. Fine. Okay. Any more questions? No more questions? Okay, great. So thanks a lot. Thank you so much. Hope you enjoyed, everyone enjoyed watching today's webinar. Hope you learned how to earn from moving averages. I would strongly recommend go back. I'll be uploading it on the YouTube. Go back, practice as you watch, and practice on lots of charts before you put your real money. Okay, don't straight away start putting money on this analysis. First of all, go do the testing, paper testing, do whether it is working for you or not working, you are getting hang of it or not. Once you are confident about the technique, then go and apply the money using this technique. Okay, so thanks a lot. Thank you for joining. See you next Tuesday. Thanks a lot. Yeah, Tia, the site is tradingview.com. You have to create a free login. I have uploaded the videos on YouTube. You can go through them. Okay. Thank you. Thank you so much.